Thank you for joining today's workshop by Zoe Financial. First, a brief disclosure. This presentation is not to be taken as investment advice and should not be relied on for such advice or as a substitute for consultation with professional accounting, tax, legal, or financial advisors. The observations made are independent of Zoe Financial and should not be read as financial recommendations. Our mission here at Zoe is to accelerate clients' wealth through exceptional experience and innovative technology. So, how does Zoe help you? Well, we reject 95% of advisors so you don't have to. All of our advisors are stringently vetted. Among them is Paul Horn, today's host for our workshop on understanding and maximizing your executive compensation. With that in mind, I'd love to share our webinar host for today. You can see him there on the screen. That's Andres Garcia Amaya, CFA. He is our CEO and founder. Prior to Zoe Financial, Andres was an executive director at JP Morgan Asset Management. There, he helped oversee over $300 billion in assets. He is a CFA charter holder and obtained an MBA from the Wharton School at the University of Pennsylvania. While at UPenn, he received both the Joseph Warden Fellowship for Outstanding Record of Academic Achievement and the Toyo Foundation Fellowship. With you, Andres.
Thank you, Alexandra. Thanks to Isa and the whole marketing team for putting together such a great webinar. So I'm really excited now to get the chance to introduce Paul Horn. Paul is the Director of Financial Planning at Benefit Financial Services Group. He takes an active role in educating clients to help them grow, manage, and protect their wealth, which is why he is in the network. He's really one of the best in the country. He's a certified financial planner and a certified private wealth advisor. He holds a Master of Science in Portfolio Management and Security Analysis from Creighton University. Paul, thank you so much for giving us your time here today.
Thanks for having me. Looking forward to the opportunity.
Awesome. So let's just get right into it. I'm going to cover here the agenda. First, we're going to go through the deferred compensation and the tax implications. And then we're going to switch gears and talk about equity compensation. You can see all the word soups there that we're going to cover. And lastly, we'll leave time at the end for Q&A. We always get really great questions, so we want to make sure we leave time for that until the very end. If you have questions as you're going through the presentation, you could put it in the chat. We'll make sure to kind of save it for the very end. Once in a while, we'll respond it right on cue if it kind of goes alongside the presentation. So with that, let's go ahead and get started. And we picked this quote here because I think it shows why it's so important to talk about this topic. 75% of median US CEOs' total compensation is delivered in the form of long-term incentives. So what does that mean? For people that are listening in that either are executives or are en route to becoming an executive, the more you understand long-term incentives, tax implications, et cetera, the better you're going to be positioned to keep more of those dollars in your pocket versus going to the government. So,
yeah.
Paul, you want to chime in already?
Yeah, I'll chime in already. Yeah. Just an important thing when we talk about executive compensation is it comes in many levels. Obviously, a high base salary is an important piece of that. But as you can see here for CEOs, that's 25% or less. When we're looking at other things like long-term incentive, those are going to be most commonly deferred compensation plans, which we're going to talk about. That'll be the stock options package that we're going to talk about. But the whole idea of these long-term incentives is they're trying to align the interests of the firm with the interests of the CEO or the highly compensated individual. And they want to use these as kind of a golden carrot to help retain the firm's top talent.
Yeah, it does create alignment, right? In essence of,
yeah,
if you're moving the needle for the company, you participate on the upside, but also have skin in the game, right? If things don't work out as expected. So it makes sense. Okay, so let's just jump right into the topic of deferred compensation. But before we get into kind of double click on the topic, we always find it helpful to just understand some of the basics, terminology, and kind of frameworks around the topic. So I'll let you take it away, Paul, here, starting with
Sure.
non-qualified deferred compensation and just a little bit more context on what that means.
Yeah, absolutely. So the whole idea of a non-qualified deferred compensation plan, and the reason they say it's non-qualified because that means it doesn't meet ERISA guidelines. And ERISA is the guidelines that manage things like your 401k, where they're very stringent, very tight rules, very much overlooked by the Department of Labor and the SEC. With the non-qualified deferred comp, what it does is it allows you to take a portion of your income, so your salary or your bonuses, if you choose to, you can delay receiving them. So instead of receiving them and paying the taxes on that money, instead you can put it into a deferred compensation plan. That money that can then typically be invested in things like stocks or bonds, so that money grows over time. And the advantage with the deferred comp plan is the money that you put into the deferred comp plan is not subject to taxes yet. So if you receive deferred comp this year, the opportunity, let's say you put in 50,000 into a deferred comp plan. Well, now you've reduced your taxable income by that 50,000 for the year. That 50,000 now can be invested in a portfolio of stocks and bonds. That money can grow over time. And then when you retire or when you want to get that money out, you'll get it out and you pay taxes at that time.
Yeah,
So
I think
deferred comp is, go
I
ahead.
moved on to the next slide here because I think you're kind of covering one of the examples, right? That we were gonna that we were gonna use here. Yep, just making sure I was. Yeah, this is why we like people like Paul going on this webinar. He's so excited about this. He's getting ahead of the next slide.
Let's go. Yeah. So with a deferred comp, so like you see here on the example on the right, for 50,000, what happens is you put that 50,000 in, and then you're going to have options when you choose to participate in deferred comp. You have to choose how much you're going to contribute into the plan, and you have to choose when and how you're going to receive the assets. So that's typically going to be either a lump sum when you retire from the company or you leave the company, or that's going to be set up like option 2, where you're going to receive a payment over a specified period of time. Typically, that's going to be 5 or 10 years. So with a deferred comp plan, what you can do, for example, is this can be an excellent bridge to meet your income needs if you retire early or in your early part of retirement. So I've worked with a lot of executives over the years where we have set this up. So right now, for example, another Zoe client who's in his mid to late 50s, he's looking to retire in the next 3-4 years. And what we've done, we've been working with him, and his deferred comp is being deferred. And what we're going to do is we're going to use the deferred comp that he's been saving. We're going to use that to meet his income needs until he reaches age 65. So he's going to retire at 60. We're going to use that for income for 5 years, because at 65, that's when he's going to start collecting Medicare. That's when he's going to start having a pension that's going to kick in. So he'll have other forms of income in retirement. So having this deferred comp plan, this is going to meet his income needs for the first 5 years of his retirement. And the advantage with the deferred comp plan is because you're deferring the taxes while he's working, he's making hundreds of thousands per year. He would have to pay a lot of taxes on that money. But because we're deferring this until after he retires, and then he's going to get a paycheck over a 5-year period, his tax rate is going from like 32% to 22%.
Oh, wow.
So he'll be saving about 10% in the taxes that he would otherwise be paying on this money. Plus it grew in the stock market as well. So it provides a tremendous value, and it's a very important planning tool if you have access to it.
Paul, question on this is there any risk or anything that people that are listening in should be aware of in the sense of maybe the firm that you work at? I'm guessing there's some type of call it like either balance sheet risk that the firm's taking on, some context around essentially like who's kind of holding the bag, right? If you're deferring comp and maybe.
Yeah, if something happens to the firm, this money's at risk. So when you're putting this money in there, you're not guaranteed to get it back if the company was to file for bankruptcy or something like that. So that is a risk when you're doing these deferred comp plans. So if you have concerns on the long-term viability of your company, that would be a very important conversation to have with a certified financial planner to see if it really makes sense for you to contribute into the plan or not. That's an excellent, excellent question.
Yeah, no, makes sense. I remember when I worked at JP Morgan, and this type of conversations came up, right? It's like, I knew that JP Morgan was at risk. Different conversation, maybe if it's, I don't know, like a Bitcoin exchange, company, right? Like, maybe not put all your eggs in one basket in the sense of deferring that comp and putting kind of the balance sheet of the firm at risk, from that perspective.
Yeah, the nice thing with the deferred comp plan is because they're not part of ERISA, they can really be used for a specific group of employees. So even if you're working at a smaller firm and you don't have this, if you're a highly compensated individual, you're important to the firm and you know that, having them create a plan like this for you can be a good bargaining chip as well. Maybe you can't get more money, maybe you don't need more salary, but maybe again, that ability to defer the taxes could be a very important negotiation strategy that you can use.
Oh, that's cool.
Uh,
That's good
yeah,
to
now
know.
the biggest mistake that I'm seeing with these is oftentimes people just naturally choose the lump sum option. They say, when I retire, when I leave my employer,
Right.
I just want to get my money back. But what happens there is you're creating potentially a huge tax implication. So if you leave your employer and you go to another employer, you may have a salary, the same salary or a higher salary, plus you've got this deferred comp now that's paying out, and that's triggering a bunch of additional taxes. So one thing that I work a lot with the people that have these plans is oftentimes we're staggering them, moving them from that lump sum, typically to a 5-year or a 10-year payout. Now, the challenge with this is anytime you make changes to the distributions that you're going to receive, let's say you go from that option 1 of 50,000 at retirement to option 2 of receiving 10,000 a year for 5 years. Now what happens is you have to push that back 5 years. So if that was going to start on the date of your retirement, you're going to get that lump sum. Now you may not be able to receive that 5-year payout until years 6 through 10 of your retirement. So when you make these elections, I would strongly recommend to talk with a CFP who can work with you to make sure that the election you're making makes the most financial sense for you in the future. Because you can make changes, but just understand there's a downside of you typically have to delay 5 years before you can get access to that money each time you make that change.
Yeah, no, and I think this is a good transition to the next slide here, which is tax implications, right? You just mentioned, hey, you could make changes, but they're limited, right?
Yeah, for sure.
And then the next one here that we have is any changes made will be typically delay the distribution by 5 years. You just kind of cover that, and you want to spread the payments out over time. It's one of those that it makes sense, but it's hard to sit down and do this kind of in one shot if you haven't done it before. I found myself in that situation when I was at JP, and it definitely helped to talk to someone and talk through kind of the scenarios and how it could play out from a tax perspective. Awesome. All right. So we have a case study here that I'll let you walk through us that could kind of bring a lot of what we just discussed home. So I'll let you take it away here.
This is from an actual client that we've worked with. His name's not Adam, obviously, but Adam retires in 2022. He has a deferred compensation of 600,000. That's the total amount. With no other income sources, if he takes that lump sum of 600,000 the year that he retires, that's going to put him in the 35% tax rate. So that's going to bump up your taxes. And if you're close to retirement age, this can create additional costs by bumping up things like your Medicare Part B and Part D premiums. This is called IRMA. Ideally, instead, most of the time it makes sense to spread that payment over 5 years. If that's what he chooses, what Adam does on the right, now he's going to get 120,000 per year instead of that 600,000. He'll get 120,000 for 5 years. That's simply 600,000 divided by 5, and that gives us the 120,000. Now he's in a tax rate of 22% instead of being in a tax rate of 35%. So you can see how proper planning can save you a lot in taxes.
Yeah, no, that's a great example. And then we have a slide here just to kind of bullet point, if you will, some of the benefits. We cover some of them, but reducing the tax burden, which we just gave a case study, income stream for the first 5 years of retirement can be a bridge to meet your income needs, right? So it's important to kind of repeat it, because I think a lot of people think that these type of plan is something that's only for that CEO in the first slide that we talked about, but for a lot of people, I remember at prior firms that I work with, majority of people, especially as they get closer to retirement, if they have a high salary, they don't have to be CEO, they don't even have to be a EVP level, could benefit for something like this. And then the last slide that we have on this topic is Paul, if you want to take this one away, just kind of the tips. Sure. That a lot of them we covered, but then maybe just to have it all one slide so people have it fresh in their mind.
Absolutely. So just the tips that I would provide with a deferred comp: work with a certified financial planner. As you can see, there's a lot of tax implications, and cash flow planning is really important when you're using these plans. Make sure if you have the option and if you have the ability to, definitely use the deferred comp plan. It is an excellent tool to help grow your wealth over time. Just when you're making your elections, as we've talked about, just really pay close attention to the distribution strategy that you choose, and make sure that you receive those distributions after you leave the firm. It's just really, really important on those distributions that you make the proper elections.
Perfect. Okay, so I see some questions on this already, but we'll make sure to hit them when we come back to the topic on Q&A. But just to keep things moving here, let's talk about equity compensation, starting with RSUs. So maybe just kind of walk us through RSUs and what they mean, what the deal is with them.
Yeah, so when we talk about stock options, there's 3 different types of stock options, okay? And the most basic type of stock option out there are these RSUs. They're also restricted stock units is what they're technically called, but most people just refer to them as RSUs, okay? They are by far the most common form of stock option out there. These are the preferred method for companies, because from a company's perspective, it's best for them, but it's worst for the employee. So since it's best for the company, they're more likely to give these out. Because for the company, if they issue an RSU to an employee, they don't have to have the underlying stock. So with other stock options like an NSO or an ISO, and we'll cover those in a second, the company physically has to own the stock, and they have to put that stock to the side that's earmarked for those employees that can exercise those options. With a RSU, they don't have to own the underlying stock, so this does not a burden on their balance sheet like an ISO or an NSO would be. So that's the main reason that the companies like them. Now, what happens with these options, when you get an RSU, what's going to happen is you're going to have a grant. So that's the date that you receive it. In this example here, that's March 1st of 2022. Is that grant date. That's the date that these were given to the employee. Now, the employee is going to be given a number of shares. In this example, they've got 1,000 shares that they're going to receive, but the employee never gets these shares up front. They're always on some form of vesting schedule. So they're not going to say, oh, you've done a great job. Here's 1,000 shares, have at it. They're going to say, here's 1,000 shares, but you're going to get 250 shares over a 4-year period. So in this example here, granted in 3/1/2022, they're not going to get the first tranche of 250 shares until March 1st of 2023. And you can see each year after that for 4 years is you're going to get those additional 250 shares. Now, with the restricted stock unit, you get these 250 shares, and that's great. When they vest, what happens is that creates a taxable event.
Mm.
So when the RSUs vest, what ends up happening with them is whatever the market price is on the stock. So let's say you have 1,000 shares, and let's say for simple math, it's $10 per share when you receive 250 shares. Okay. So that it becomes $2,500, right? That's just $10 a share times 250 shares, total of $2,500. That $2,500 now is treated as taxable income in the year that they vest. So now you have to pay income taxes on those 250 shares. When they vest, you can choose to keep the shares and let the stock grow, or you can choose to cash them out, and by selling the shares, paying the taxes, there's a mandatory withholding of 20% that the company has to withhold to pay for federal taxes. And then you will get the remaining money minus the taxes that are owed. Now, from a tax perspective, because they're treated as essentially a cash bonus, that's typically the best way to handle the RSUs. So the RSUs, like, think of a cash bonus, right? They give you $2,500 cash, you tax on all $2,500. The RSUs work the exact same way.
All right.
So I prefer to treat them like a cash bonus. You sell the stock, and then you take that money. Don't go spend it on something expensive. Don't buy yourself a new car with that money. Use that money to be invested in a more diversified portfolio of stocks and bonds. Because what happens with these stock options is if you keep them and the company does well, that's great. But if the company doesn't do well, that really can impact you because you have a lot of money tied up in one position. Think of it from this perspective. Your biggest asset is you. You working at that company, receiving that salary and all the executive comps, that is your best earnings potential or the greatest way to grow your wealth over time. You have a lot of risk with that company already. So if something happens to the company and you get laid off, that's already a lot of risk. But if you're getting laid off, the stock probably isn't doing well. You're probably in a recession or something like that. So now you're going to lose value on your investments on top of you potentially losing your job.
Yeah.
So you're much better to try and keep a little bit of as little exposure to your company that you work for as possible, and have other stocks and other bonds that you're invested in to be diversified to avoid what's called concentration risk, where all your assets and all your earnings potential is tied up in one company.
Yeah. No, and we definitely seen that in the technology space over the last year, right? Where people were holding on to all their shares, at large social media companies, for instance, and then the stock's down 70%, and they never were over time diversifying some of those shares. So definitely an important kind of like unemotional way to diversify, rather than kind of try to time when is the right time to do it.
Yeah,
Yeah,
it's just
sure.
easy. And there's a question, if you don't mind me, I think now is a good time to answer it.
Sure.
Somebody asked, how do I know how much I'm going to be taxed on my RSUs? And that is in the year that they are, the example here I gave, the 250 shares at $10 per share, that creates 2,500 in additional income. You're going to pay whatever your highest income tax bracket is at the federal and the state level, that is going to determine the tax rate that you pay.
Mm-hmm.
So you can just Google.
So it depends on how much money how much income you are generating through your salary and bonuses, etc. That dictates
all your other sources of income. Correct. This is just added to the top of it. So whatever that highest bracket is, that's what you're going to pay. Again, a CFP or a tax professional is the best people to answer that. If you want to look for real quick, just Google tax brackets 2022, 2023, see what income you're going to be at for that year, and that'll give you a good ballpark.
Mm-hmm. Mm-hmm. All right, just to close our thoughts here on RSUs, You covered this one, but let's just go through kind of some of the tips here for people to keep
Yeah.
in mind.
Yeah, treat it like a cash bonus, like we've talked about. Sell them when they vest, use that money, get it reinvested in other investments. If you choose to hold this stock, hold it for at least 1 year. Okay, they are subject to the normal short-term capital gains versus long-term capital gains rules. So if you hold the stock for less than a year, so let's say it vests on 3/1 and you sell it 10/1 of the same year, you only held it for 7 months. Now those gains in the taxes from the difference of the marketplace when it vests to the price when you sell it,
Mm,
that gain is taxed at your normal income tax rates. If you hold it for at least a year, for at least 12 months from the time that it vests. So vests on 3/1/2022, sell it after 3/1/2023. Now you're paying long-term capital gains. So that's going to be at a much lower tax rate, potentially 0% taxes on that, depending on your tax bracket, of course.
yeah, that's a really good one.
If you're receiving these, you typically can negotiate with your employer. It's in your best interest to try and negotiate for either what are called non-qualified stock options or incentive stock options. Those are more favorable for you from a tax perspective.
And I think we're going to cover options in a second
Correct.
too. Yep.
And just be aware, if you're going to leave your employer, any unvested RSUs, you are automatically going to lose. So if you're considering maybe leaving to retire or leaving for another employer, it's just important to know, look at your unvested RSUs because you will be leaving that money on the table. So you're going to want to negotiate that amount with your new employer to see if they can replace what you're going to lose by leaving.
Okay, perfect. So that's RSUs. Let's cover now the non-qualified stock options.
Okay, so non-qualified stock options are similar to RSUs. The key difference here, though, is you, the employee, choose when you trigger the taxes on these. Okay, so with an NSO, a non-qualified stock option, again, there's a grant date. That's the date that you're going to receive the NSO. Okay, with the NSO, you can go ahead and bring up the example. With the NSO, there's really three terms I want to make sure you guys are aware of. The first one is called the vest date. Sorry, the first one is called the grant date. The grant date is the date that you receive the stock options from the company. Okay, that starts the clock. The next one that's important to know is what's called your vesting date. The vesting date is the day that you can begin to take advantage of those stock options that you've been given. And on NSOs, we have another layer on top of that, and that's called your exercise or your strike price. So when they give you these non-qualified stock options, they're going to give it to you at, and they're going to specify that you're buying the stock at a specific price. So with a non-qualified stock options, essentially all they are at the end of the day is a contract between you and the company where you have the option to exercise the stock option at gives you the option to buy the stock at a specific price. In this example, you've got ABC stock, you receive 200 shares, and they're giving it to you where you can purchase the stock at $25 per share. Okay. And then these always have expiration dates. Like anything in life, it doesn't last forever. Typically, these stock options last for 10 years. So if it's granted to you March 1st of this year, typically they're going to expire by, 3/1/2032. So 10 years out, you have to exercise everything, otherwise you lose them. Okay. Now, when you choose to exercise them, what happens is the difference, it's called the bargain element, but the difference between the price that you're purchasing them at, in this example, that's that $25 versus the market price of the stock at that time. In this example, it's $40. That difference, in this case, it's $15 per share. That portion is subject to income taxes. So unlike an RSU, where the full market price is subject to income taxes. With an NSO, you control when to do this. So you can choose to do this when you're maybe retired or maybe in a lower income year. So you control the timing of the taxes, and the tax hit is smaller than the RSUs.
Right, because it's just a difference. You get taxed on the difference rather than the total amount.
Correct. So
Yeah.
looking at this example here, let's say that they sell all 200 shares, $40 a share times 200 shares equals 8,000 in total value. Now they're purchasing the stock at 5,000. That's at $25 per share times 200 shares, right? So that gain on the position is $3,000. That $3,000 amount, also known as the bargain element, is the portion that is subject to income taxes.
Yeah. Yep. No, that's great. By the way, for Zoe people that are listening in, wink, wink. That's why we picked NSOs. So it helps you with your tax bill. All right. Let's go through the tips here for this ones.
Yep. Again, like RSUs, if they're not exercised at the time you leave the company, you are going to lose them. If you're looking to retire from a company and you have NSOs, you have to be very careful on understanding how it works. For example, another Zoe client that I'm working with right now, he's 52. He wants to retire in the next year or two. The rules of the company that he work at on his NSOs, he has to stay there until age 55. If he retires at age 55, he can wait and actually exercise them later on. So he doesn't just lose them if he retires at age 55. If he retires before age 55, he just loses them. So because of that, we're going to have to exercise all those NSOs while he's still working, because he's not going to have the luxury of waiting since he's going to retire before the age 55. So it's very important to pay attention to that. And then when you exercise the stock option, you have the choice of keeping the stock or keeping the cash. Again, typically it's best from a tax perspective to just sell the stock, reinvest elsewhere, because again, you have to pay taxes when it's exercised. So if you hold on to the stock, you're going to have to come up with the cash out of your bank account or out of another place to pay for those taxes. So most commonly people will sell all the shares, have it cover the taxes for them, and then they'll just take the amount less the taxes withhold, the tax withholding.
Got it. All right. So that leaves incentive stock options here. Why don't you kind of walk us through this ones?
Sure. So the ISOs, these are the unicorn of stock options. These are the creme de la creme. They are fantastic, but unfortunately, these are becoming less and less common. Really, the only place that I'm seeing these incentivized stock options these days are for tech startup or biotech startups. Those are really the two main industry that I'm seeing. And the startups are using these ISOs to attract top talent because they may not be able to match the executive benefits of the larger firms or even the pay of the larger firms. But with these incentivized stock options, they're going to be more favorable for you as an employee, because what happens here is instead of paying income taxes like you would on a non-qualified stock option, instead you get to pay long-term capital gains tax rates. So where the top tax bracket under like an NSO or on your income tax bracket is 37%, the top tax bracket here is 23.8%. So you're going to pay almost half the taxes that you would otherwise pay potentially if you have the ISOs. So with the incentivized stock options, there is some requirements to be able to get that long-term capital gains tax rate instead of income tax rates. To do that, what you have to do is, number one, you have to hold the stock. You have to, number one, wait to exercise the stock. At least you have to receive the grant, and you can only exercise 1 year later. So if we receive the grant on March 1st, 2022, you need to exercise it after March 1st, 2023. And then when you exercise it, you have to hold it for another year. So you have to exercise it 1 year from the date of grant, and you have to sell the stock 2 years from that date of grant. So essentially you wait 1 year then you exercise it the first year. If you choose to, again, you control the timing of when you choose to exercise this, but you have to meet those 2 criteria to get the long-term capital gains tax rate. Now, with the ISOs, these are a little bit different because at the time you exercise them, you're holding it, but when you exercise these, you're not taking the cash, you're holding the stock. Okay. Unlike the NSOs where you typically are better off taking the cash instead of holding the stock. With an ISO, you're going to hold the stock when you exercise. But when you exercise, it is what's called an AMT, or alternative minimum tax add back item. Now, AMT rules changed in 2017 as part of the TCJA, so it's not that big of a deal these days. The only people that are going to be caught are those with large ISOs and large income. If you make $750 to $1 million a year, this is going to be a very real concern for you, because the AMT is an alternative tax. And with AMT, you pay the greater of the AMT tax or your regular tax bill. And the AMT is a design, so you always pay the AMT. And once you're in there, it's like purgatory. It's really difficult to get out.
Right.
So, yeah.
So the next slide here is just to kind of summarize it from a tips perspective. You covered some of this already, but yeah, take it away.
Sure. So the 2 main tips with the incentivized stock options, they work like the normal options where you control the timing, like we talked about. But the IRS has a very specific rule that you can only exercise 100,000 per year in ISOs. If you let's say you have 300,000 in ISOs and you exercise, say, 200,000 in 1 year, what the IRS says is 100,000 out of that 200,000 is ISOs. The other 100,000 now automatically becomes NSOs, or non-qualified stock options. Okay. So there's this 100,000 per year rule that you have to be aware of when you're exercising these. Now, for some individuals, it may actually be beneficial to switch them from an ISO to an NSO by not meeting those withholding criteria of the 2 years from the grant date for the sale and 1 year for the exercise, or going above that 100,000 mark. Areas where that might make sense is, one, if you're subject to AMT already, or you're going to be subject to AMT taxes like we talked about, or secondly, if you're going to switch employers. Because like the other stock options, you lose these when you go to another employer. So for example, I have another Zoe client that is in the process of wanting to switch jobs in the next 1 to 2 years. She worked at the firm, had their IPO, it popped, did very well. It's got hundreds of thousands in these ISOs that she's trying to get rid of, but we need to get rid of them in the next 2 years so that she doesn't lose them when she switches her employer. So we're going to intentionally switch a lot of them to that NSO tax treatment so that she can make sure that she gets the money before she leaves. Lastly, in a down stock market year, i.e. this year, it can be very beneficial to exercise the ISOs, because remember, you exercise and you're holding the stock. So if we exercise them in a down year, that's actually a good thing, because now you can exercise a larger amount, more shares, because it's a lower stock price, because we have to stay under that 100,000 rule. So if the stock price is lower, that means more shares that you can exercise and hold and just sell it when the stock rebounds and does better in subsequent years.
Right, because you only pay for the spread. So if the spread, when it comes to taxes, so if the spread now got smaller, you pay less taxes on it.
Correct. And with the ISOs, you're not paying at the time of exercise, you're paying at the time of selling the stock. So you don't even have to, so if you exercise this year, it's an AMT item, but you're not creating additional income taxes or long-term capital gains taxes by exercising your ISOs.
Right. Yeah. In essence, for NSOs or ISOs, for both, essentially, there's benefit there. Got it. Okay. Well, last one here, employee stock purchase plan. Is there
So the
that
employee stock,
acronym ESP? Is there a industry acronym for that? ESP?
no, it's just ESPP. There's also, it's
Okay.
called an ESOP, employee stock option plan.
Yeah, that's what I thought. I usually see ESOP, but yeah, okay.
Yeah, yeah, and we can cover ESOPs but for sake of time, we're today going to focus more on the ESPP. Now, this is a benefit for not just executives, but for all employees of a firm. But I always want to include it because I think it's one of the most underutilized benefits out there. In fact, it's probably the most underused employer benefit that's out there. With an employee stock purchase plan, the employer allows you the opportunity to buy the company stock. Now, in this case, you typically can buy it at a discount of anywhere from 5 to 15%. The max discount that they can give you is 15%. So if the stock is worth $100 per share, you're buying it at $85 per share, potentially. So you make $15 per share on the first day that you buy that stock. So you've got a built-in return of 15% on that. So I really think these are important to contribute a portion of your paycheck to, because these are withheld from your paycheck when you make the purchase. Now, when you do that, it allows you, as you see here on the example on the right, the stock price is $20 per share. Company is offering a discount of 10%. So the employee instead is paying 18 instead of $20 per share. So they're automatically making $2 for each share that they buy. And as that stock price goes up, they're just making more money.
Is there usually time constraints or anything when you buy stock through this program versus, like the grant date, invest date for the prior slides?
Yeah, there typically can be some restrictions. There could be some what are called blackout periods where you're not able to sell the stock. But typically, again, it's a stock that you're purchasing. So we want to hold it for at least 1 year, because it's like any other stock. If it's held for less than 12 months, any gain is taxed as income. So we want to hold it for at least 1 year to get the long-term capital gains tax treatment, pay those lower taxes, keeps more money in your pocket.
Got it. No, that's really great. Then we got here a slide on the tips for ESPPs.
Yeah, and so with the ESPPs, you don't put all your paycheck in there or all your free cash flow or extra money that you have, but a portion of it can certainly go in there. And they're a great way to accumulate wealth over time because it's sitting in an account that you're contributing to before you receive your paycheck. It's taken right out of your paycheck. So it's a great way to have an automatic savings plan. And then that stock is a stock. So as the stock grows over time, that value grows over time. So it's a great wealth accumulation tool. It's a great tool for, like, let's say you want to buy a rental home or start a business in 5 years. Using ESPP is a great way to help fund those types of goals. Just when you're gonna make any sort of contributions to these plans, make sure you do some cash flow planning to make sure that you are having other money to go towards other goals and you're not putting yourself in a position where you can't pay your bills because you're putting too much into the stock options account. And then just be aware of stock concentration risk. If you have the stock options like the RSUs or the NSOs and the employee stock purchase program, the ESPP, you're going to want to work with a CFP to figure out when and how to contribute to all of them. So you're not too much of your worth isn't tied in the employer stock like we've already talked about.
That's perfect. All right. So keeping an eye on time here, and we got a number of questions as it is. Let's go to this slide here. We always like to end the presentation by asking, why you became a financial advisor, Paul, right? Everyone's got kind of their own personal story here. We'd love to hear yours.
Sure. So for me personally, I'm somewhat altruistic. I just like to help people. I naturally enjoy teaching and helping other individuals. I just know I don't have the patience to be a teacher. Blessed those people that teach these days, and God, we need more good teachers, more than ever. So my hat's off to anyone that knows or anybody that's involved in that profession, because that is a wonderful profession. For me, I chose the path of a social worker. I did that for a while, realized that it wasn't the ideal situation for me. Again, wanting to help others, that was the kind of natural course of action. My undergrad is actually in clinical psychology. But I enjoyed doing it. It just wasn't the path I want to be for the rest of my life. My best friend's dad was a financial advisor. He grabbed me at 18, taught me how to handle credit cards, how to do a budget, got me investing in stocks early on, really piqued my interest in that industry. So for me, he kind of became a mentor and helped me get into it. You know, I have my certified, I'm a CFP, CPWA, Master's in Investment Management, undergrad in clinical psych. My undergrad in clinical psych is my most valuable education. Because at the end of the day, we're in the business of helping individuals. You know, my wife calls me a glorified hairdresser, which is kind of funny because I kind of lack the hair up here. But she calls me a glorified hairdresser because at the end of the day, all I'm doing is listening to people's problems and helping them solve them.
That's great. Love that. Thanks so much, Paul, for sharing that. I love kind of the social worker background. Does show, and you know, a lot of people say, "Hey, I like helping people." It's like your background shows that you actually do. So really appreciate you sharing that.
Yeah.
Now, I already see this question. We're going to go into Q&A, but I already see this question a couple of times over, which is how do I go about hiring Paul? Right. So might as well address it up front. If you want to connect with an advisor in our network, in this case, for instance, if you want to connect with Paul, you could call 646-680-9244. You could go to our website, zoefin.com, fill out a quick form, and then our concierge will be able to help you once they see that form filled, or you could email them directly, concierge@zoefin.com. And important to kind of note that at the beginning, we mentioned that for Zoe, we really do have a very thorough due diligence process of the advisors that get into our network. Is not just about knowledge, right, and process. We do care about finding advisors that are client-centric and want to help people. And hopefully right after you saw this, you know a lot of what we mean by this is it's people that really comes through, right, that they enjoy helping others. And that's really who you want to hire as an advisor, right? I'm sure you've had doctors in your life where they might have been, you know, smart, but you're like, God, I hate going, right? Like they don't seem to care. They don't seem to care about me. I'm just another number. So we really wanted to emphasize that in our due diligence process to bring in people that really seem to really enjoy helping others. First, thanks to Paul for taking this time, not only kind of walking us through all the material, but really, I mean, those nuggets in the Q&A were super helpful. I was taking notes for myself over here. So thanks so much, Paul, for that. Thanks so much for the marketing team as well, putting this together. I saw a couple of questions regarding, can I get the recording? You will get the recording for this later on today. And feel free to share it with family or friends that you think that this information could be helpful. So thanks everyone for showing up, and thanks Paul for your time.
One last plug, guys. Again, thank you so much for having me. I did write a blog series as well. And so I believe that'll be posted on Zoe's website in the coming days as well, if you want to read more material about what we talked about today.
Awesome. All right, Paul, have a good one.
All right.
Bye, everybody.
Thank you so much, guys.
Take care, everybody. Bye.
Thanks, Paul. Bye now.